A longer title would include, along with gold, items such as diamonds, platinum, oil, land, Bitcoin, cigarettes and other assets used as a medium of exchange. But let's get our terminology straight, for there are two kinds of thing in this world. Only one of these classes of things has been used as a currency. Everything is either an asset, or equity. At least for the purposes of this discussion, there is nothing else. Only assets have been used as a currency. Assets are those things created by God. Assets are perceivable by the senses. That is, all assets are material, like gold. But this is not the real definition of an asset, because assets are things owned. Gold in the ground is not an asset. It becomes an asset as it becomes property. So, assets are things owned by someone with value. Money is an asset that is divisible into convenient units of value. Money, at least the conventional forms of it, are owned by someone who sells or lends access. Usually the seller has the capacity to digitalize the asset into precise packets of value. For this service the lender pays a fee called interest. The amount of money that has been borrowed from someone, along with the accrued interest equals the outstanding debt. People wonder who the $300 trillion of debt, that exists in the world, is owed to. It is owed to everyone who has lent money and has not received full payment including principal and interest. But that is because debt cannot be paid off. No matter how you slice it, the money that has been borrowed never equals the principal plus interest outstanding. How do we pay back $130 if we borrowed $100? The interest does not exist. The longer we go without paying off the principal plus interest, the more the interest portion inflates. There is no limit to how high the outstanding interest can get. Theoretically we could borrow a $100. 00 and over time, with compounding interest, owe $1 million or more. If we were on an island with one other and he lends us $100 at 30% interest, how would we pay him back? But let's look at gold because many people think that using gold means that we can avoid debt and the curse of compounding interest. This is true on paper but not specifically true in practice. Unfortunately, people do not grasp the true nature of money. If they did they would know gold is not and cannot be money even when used as a currency. There is a technical difference long ignored by writers, including economists and bankers. Money is considered to have or express three different aspects. It is a medium of exchange, a unit of account, and a store of value that facilitates economic transactions and simplifies trade. A more general way of understanding currency is as a socially agreed upon system that permits people to trade goods, services, or resources without the inefficiencies of bartering. This is misleading, however. The definitions given focus on the use of money, rather than its substance, even though currency always has a physical correlate. Is money a store of value? Think upon this for a moment and ask yourself, if it is able to store value in a system that is perpetually inflationary. Money, they say, eliminates direct barter. However, it does this only because it is composed of an item commonly accepted in trade. For example, you can buy bread with dollars, instead of trading a chicken for it. But you can still exchange gold for diamonds without gold being turned into coinage. At what point do you cease to use gold coins for the purchase of product, if the value of gold is going up relative to other goods and services? Money systemizes barter or digitalizes a commodity. Currency does not truly eliminate barter nor even replaces it. Currency turns barter into a more objective process by means of a standardized accounting medium. A dollar is a known quantity that can be used to quantify all other values. Indeed, changes in interest rates reflects the changing value of money as a barter item. Money is not just an accounting mechanism, it is a product accounted or measured by the system of measurement, which makes money fluctuate in value. Which makes money akin to a measuring tape made of rubber. Money, thought of as a unit of account, serves as a standard measure of value, making it easier to compare prices and calculate worth. A car might cost $20,000, and a loaf of bread $3, giving a clear relative value. These values can be recorded on a spreadsheet. The question is, even accepting that money is a unit of account, do the currencies we use function as a unit of account, when their values are subject to change? Money is also claimed to be a store of value. Economists argue it retains value over time, allowing people to save and use it later. Unlike perishable goods, money, in stable economies, holds purchasing power for future use. However, the qualification, in stable economies, is notable. Stable is a highly relative term, and any nation undergoing inflation is inherently unstable so far as its currency is concerned. Money enables debts and future payments to exist. Debts or future payments such as loans or mortgages, are denominated in currency units to be settled at a future date. Money to exist must fulfill certain functions. Money has a set of characteristics that sets it apart from other commodities. Acceptability. Money as a medium of exchange, needs to be widely recognized and trusted by people and institutions. Durability. Money needs to be able to withstand wear and tear and retain its physical form over a long period of use. Portability. Money must be easy to carry or transfer. Divisibility. It's vital money be divisible into smaller units, e.g., a dollar into cents, but able also to represent any of an infinite number of higher values. Uniformity. Each unit must be identical in value, e.g., all $1 bills are equal. Limited supply. Controlled issuance to maintain value, often managed by governments or central banks. Secure. Money must also be secure to some degree, not able to be counterfeited or stolen or debased. Stable. Money ought to be stable and maintain its value over time, but in economies that see value in inflation, this element of money has been discarded. Inelastic. It might be assumed that a monetary system is not subject to distortions or elasticity during or due to usage. What good is a measuring tape made of elastic or rubber? If we spend gold and cause the value of gold to increase, we may well be hesitant to spend gold, preferring to hoard it and watch as its value appreciates. This is actually a serious problem with most forms of currency, the fact that one can make money without making anything intermediate between the investment and the profit. Money, due to the many requirements and uses, gives us various forms of money. Commodity money is money that is imbued with intrinsic value, such as gold, silver, or salt, though in fact anything with scarcity value that cannot be readily produced, seems to contain intrinsic value. Representative money. Paper or tokens backed by a commodity, like gold certificates redeemable for gold. Fiat money, modern currency, e.g., USD, Euro, with no intrinsic value, accepted because of government backing and legal tender status. Digital money, bank deposits, cryptocurrencies, like Bitcoin, or mobile payment systems, existing electronically. Money emerged to solve the double coincidence of wants problem in barter systems, where both parties needed to desire each other's goods. Early societies used shells, beads, or livestock as money. Over time, metal coins, paper currency, and digital systems developed, with central banks, like the Federal Reserve, now regulating supply to control inflation and stabilize economies. Money, being universally desirable and fungible, eliminated the need to create a parity of need. The two partners to an exchange, the buyer and seller, did not have to negotiate relative values, as money served as a go-between in any exchange. The item sold could be converted into a monetary value, and the monetary value could then be converted into an item purchased to compensate the seller for the item disposed of. Because money can be issued in any amounts, it lubricates trade, supports complex economies, and enables taxation, investment, and wealth accumulation. Money, in other words, enables all sorts of transactions and exchanges to take place that would not otherwise happen or would happen only with the utmost difficulty. However, when the value of a currency has no bearing on its material value, its value depends on collective trust. If trust in the currency erodes, for example because trust in the institution issuing the currency is shaken, hyperinflation follows, and eventually the people will return to direct barter. The use of fiat money enables excessive debt or inequality, while cryptocurrencies challenge centralized control, though they face volatility and regulatory hurdles. For example, we can use a fiat currency to buy groceries, medium of exchange, measure the cost of a meal, unit of account, or save it for later, store of value. Its value comes from trust in the government issuing the currency, not from the paper itself. However, trust in governments are at an all-time low, possibly because of the way they have handled money. World debt continues to increase. Money goes to where the interest is highest, and as this is paid back, it is lent out again, but the interest cannot be paid back, and as it is paid down, it goes to make more debt to pay off previous loans, so it is a self-reinforcing cycle. This mounting debt and the inflation it begots, destroys faith in the currency and erodes trust in the issuing authority. But when we barter, there is no trust displayed. On the other hand, the trust we have put in governments and central banks has proved ill-advised, so we need a monetary system based on trust, and to have that we need it to be backed and issued by an authority that can be trusted. We know this is God, but God has assigned Christians to be His standard-bearer, to represent Him on earth. However, there are wolves among us, and so we need a different way to recognize His flock, than a simple profession of faith. It has become an attestation too often made as a way to deceive the elect. Christians are required to have faith, and while this is generally interpreted as needing to have faith in God, it is incomprehensible to have faith in God and distrust your brothers and sisters in Christ. So the market and the church ought to be coextensive. The church, properly constructed, ought to issue our currency, which is only a unit of account, issued to track income and expenses. Trust is better than gold, because without trust, even gold cannot produce economic development, it will more likely be hoarded. When a person adds value to an asset, he creates value according to the labor theory of value. According to Scripture, he has a right to his wages. Therefore the church, as God's representative on earth, pays the worker for the work that he or she does. There is no reason why housewives ought not be paid for the work they do and the value they add to the church community. The worker has an account with the church into which earnings are deposited, which are then used to purchase other goods and services. And while this is a highly truncated discussion of how a church ought to work, it tells enough. The only basis on which money ought to be issued is on the basis of equity, that is the value a worker creates as she or he adds worth to an asset. This work represents faith in God and faith in the people of God, and it is rewarded by a deposit to the member's account. Faith, as we have said, is better than gold, because it serves as the basis of a stable currency, one without debt or inflation.